Welcome to 3-Point CV with Tom Lee. Midterm elections are around the corner, and while there's not a ton of uncertainty out there, the issue that's most uncertain is majority control of the House. This has proven to be a pretty critical point for markets in the past. Here are the key points. As I mentioned, midterm elections are around the corner, and House majority control is uncertain. Since 1896, markets are strong post-midterms except in the instances when the House shifts majority control. Somehow that's an important pivot. Past House midterm shifts risked the agenda of the incumbent administration, and we believe that's actually one of the reasons markets did poorly. We don't believe that's the case in 2018. So here are our conclusions. First, we still expect a year-end rally given the positive seasonals, performance chasing, and also market behavior into the around post-midterm elections. But as we look into 2019, the outcome in the midterms is actually going to play an important role, which we'll discuss in this video. It's generally accepted that markets perform well after midterm elections and in the year following a midterm election. The best place to start is to take the S&P returns since 1896, and the median annual return is 9.8%, and the market's up roughly 2/3 of the time. In the year following a midterm election, the median return for the S&P 500 is 14.3%, and that's in 30 of the 122 years. Pretty substantial outperformance. And in the years excluding post-midterm periods, so everything else, the remaining 92, the median return is 8.4%, so substantially lower. In other words, there's quantitative proof to the idea that markets perform well in the year after midterm elections. We can mark a path for the S&P 500 into year-end 2018 based on the composite of past midterm elections. From mid-October to election day, markets average about a 1.4% gain, or roughly 40 points, and that implies at 28.15 for the S&P 500. From election day, which is November 6th, to year-end, markets' median return is roughly 2.3%, or 65 points, and that implies that we would end the year if roughly 2,900. So again, pretty good upside. And if we follow the path in 2019 of past post-midterm years, that implies a 14.3% return, or 415 points, and roughly 3,300 for the S&P 500, which means next year should be a good year for markets. And as I mentioned, the uncertainty in the 28 midterm elections is control of the House, whether Republicans retain control. Tom Block, Fundstrat's head of policy, sees the Dems narrowly taking the House with a net gain of 25 seats. 538, which is another well-regarded site for tracking political developments, and they currently expect Democrats to take 39 additional seats, which would give them control of the House. Based on all their outcomes, an 84% probability that the Dems control the House. So let's go back to this chart thinking about equity returns post-midterms, those 30 years post-midterms, but see whether or not the shift in the control of the House makes any difference. Of the 30 years post-midterm, there was no change in control of the House, 22 of the instances, and median return on markets was 16.8% and a 77% win ratio. Clearly, when there's no change in House majority control in post-midterm years, markets do extraordinarily well, even better than the overall post-midterm years. But there are 8 instances where House majority control changed, and the median return for markets is only 1.9%. In other words, if the base case of forecasters is correct and there's a shift in House majority control, this actually bodes poorly for 2019. But let's take a deeper look at those 8 midterms to really understand why markets perform poorly. The first instance was 1910. Now, in 1910, there was a split in the Republican Party, which is why the Dems took control, and in 1911, equity markets were flat. In 1918, the country was not happy about entering World War II, and we saw a positive 30% gain in the Dow Jones. 1930, now that was in the midst of a Great Depression, and not surprisingly, 1931 was a bad year. 1946 was the next instance. We had a Democratic president, and the House went from Democratic to Republican control, and the markets were flat. 1954, equities were firmly entrenched in a bull market, but the country was tired of McCarthyism. So they voted the House Republicans out and brought in the Democrats, and the market rallied 26%. In 1994, we were in the midst of a bull market, although 1994 was actually a tough year for equities. But there was backlash against the Democratic House, especially on issues like the proposed healthcare reform, and the GOP was successful selling the idea of the contract with America, and markets rallied. 2006, it was a Republican trifecta, and there was a war that was going very badly, and when the Democrats took control of the House, the following year the markets were flat. And the last midterm that saw House control shift was 2010. That was a Democratic trifecta. There was already anxiety over the economy and the fragility of it, and there was backlash against the Obamacare Affordable Care Act, and markets were flat. So we have some takeaways. When voters are unhappy with the direction of divisive issues, markets can rise out of celebration that this change was good. 1918, 1954, 1994. Those are actually the three of the good 5 years, and those are highlighted here. Sometimes there are bigger issues that divide the country that can't be solved with an election. 1930 and 2010 come to mind, and markets didn't do poorly. And there's instances when the voters are unhappy with the incumbent agenda, and for instance, when the party fractured in 1910, or when voters were unhappy with the policies of 1946 and 2006. In those cases, markets did poorly, even though we had some shift in the agenda. We've already laid the case that if House majority control shifts, this bodes poorly for equity markets in 2019. However, we think that this is going to fall into one of these exception cases, and the reason for that is we believe that the Republican agenda remains intact. The country is generally satisfied with the direction of the economy. It's evident in the presidential approval ratings, and he's getting particularly good marks for his handling of the economy. Now, there are some social issues at play, things like Me Too, Supreme Court appointments, and they're less about the Republican economic agenda. The Republican agenda, therefore, is intact. We have tax cuts that are in place, pro-growth policies in place, and the U.S. is the global TINA. There is no alternative. Think about it. There really isn't an alternative. Emerging market visibility is weak. European economic visibility isn't that great. In the U.S., pretty good economic momentum. So to summarize, as we know, anything can change in the next 2 weeks. But even if Democrats take control of the House, we don't think this is a worst-case outcome, because the economic agenda for the Republicans remain intact, and generally that's going to be good for equity markets. Thanks for listening. This is Tom Lee with 3 Points TV.